Hey everyone, and welcome to The Explainer. Today we're diving into a company pretty much everyone knows, a real giant in the creative space, Adobe. I mean, seriously, if you've ever edited a photo, designed a logo, or even just opened a PDF file, you've been in their world. They are, without a doubt, a phenomenal business.
But here's the million-dollar question for us as investors, right? Loving a company's products is one thing, but does that automatically make its stock a smart buy? You know, at whatever price it's at today? It feels like a total no-brainer, but here's the thing. The best investors out there know that a great business and a great investment, well, they can be two very, very different things.
So how do we figure this out? Well, we're going to put Adobe through a really tough, time-tested framework. We're going to use what's called the Warren Buffett check, a set of principles from one of the greatest investors of all time, used to separate the merely good companies from the truly great investments.
So our mission here is pretty straightforward. We're going to use Buffett's 4 key rules to see if Adobe is not just a wonderful company to admire from afar, but also a wonderful stock to actually own at its current price. Let's see if it holds up.
Okay, let's dive right in. We're going to start with the absolute first pillar of the Buffett check, the quality of the business itself. The big question is this: does Adobe have a truly durable competitive advantage? I mean, can it fight off competitors not just for a year or two, but for decades to come?
Buffett has a great name for this. He calls it an economic moat. And you can think of it just like a castle, right? A wide, deep moat protects the castle inside from any attackers. And for a business, that moat protects its profits from the competition. For any true Buffett-style investment, a strong moat is like a total non-negotiable.
And when you look at Adobe, wow, its moat is absolutely massive. First off, the business is simple enough to understand. They sell software subscriptions. They've got a long, super stable history founded way back in 1982. Their brand is so powerful that to Photoshop something is literally a verb in the dictionary. But honestly, the real killer here, it's the high switching costs. Think about it. Entire industries of creative professionals have built their whole workflows around Adobe's tools. For them to switch would be unbelievably expensive and just a massive headache. And that gives Adobe incredible pricing power.
So, the verdict on test number 1? It's a slam dunk, an absolute resounding yes. Adobe has that deep, wide, and durable moat we're looking for. It passes this first check with flying colors. This is exactly the kind of predictable, dominant business that Buffett just loves to see.
Okay, so Adobe is a fortress. We've established that. But does the treasure chest inside match the strength of the walls? Let's dig into the numbers now. Because a great story is one thing, but we need to see if the financials actually back it up. Is Adobe a true money-making machine? All right, first up, let's look at a key number called return on equity, or ROE. The easiest way to think about this is, for every dollar the shareholders have put into the company, how much profit does the company spit out? Now, Buffett, he likes to see this somewhere in the 15 to 20% range. Adobe's 5-year average is a jaw-dropping 36.7%. That is just an exceptional level of profitability.
Okay, next up, the gross profit margin. And this number is just incredible. What this means is that for every single dollar Adobe brings in from sales, nearly 88 cents is pure gross profit. That's before you pay for other stuff, of course, but that is the beautiful, beautiful economics of a dominant software company. It costs them basically nothing to sell one more subscription.
And then there's this number, free cash flow. This is what Buffett famously calls owner's earnings. This is the real cash that's left over after the company pays for everything it needs to run and grow. And in just the last year, Adobe generated a staggering $9.6 billion of this stuff. It's like a massive, growing river of cash that management gets to play with. So you look at all that, and the conclusion is crystal clear. Adobe's financials are, well, they're pristine. It is a capital-light, cash-gushing machine. So it easily passes the second major test. So far, Adobe is looking like a perfect investment, right?
Okay, so the business is amazing and the financials are stellar. On paper, this is a 10 out of 10 company. But, and this is a big but, this is where the story gets a whole lot more complicated. Because even the best company on the planet can be a terrible investment if you pay too much for it.
So first, let's touch on management. Their integrity is high, no question there. And they're smart. They reinvest their earnings back into the business to grow it instead of just paying out a dividend. That's a check. But there is a bit of a yellow flag. Their really aggressive attempt to buy the company Figma for $20 billion, it raises some questions. It kind of suggests they might be willing to overpay for growth, which is a bit of a red flag for a disciplined value investor.
And that brings us to the most crucial point of this whole thing. This is Buffett's #1 rule, margin of safety. The idea is actually pretty simple. You figure out what a business is really worth, its true intrinsic value, and then you demand to buy it for a lot less than that. It's like finding that dream house that you know is worth 500 grand, but you refuse to buy it unless you can get it for, say, 400 grand. That $100,000 gap? That's your protection. That's your margin of safety.
Okay, so let's apply that idea directly to Adobe. Based on a pretty conservative analysis of its future cash flows, our estimate for Adobe's intrinsic value, what it's actually worth, is somewhere around $400 per share. And right now, as we're looking at this, the stock is trading for about 320 bucks a share.
Okay, so do the math on that, and it means the stock is trading at roughly a 20% discount to what we think it's worth. Now, on the surface, that sounds pretty good, doesn't it? You're essentially buying $1 for 80 cents. But the real question is that good enough?
And this right here is the turning point of this entire explainer. See, for a really conservative, Buffett-style investor, a 20% margin of safety, it's just not enough of a cushion. The future is always uncertain, right? Things can go wrong. A truly deep, compelling bargain, the kind Buffett waits for, might need a discount of 25, 30, maybe even 50%. And so on this final and most critical test, Adobe, well, it just doesn't clear the bar.
All right, let's tie this all together. Let's look at the final scorecard and see how Adobe stacks up when you look at the whole picture.
So here it is, the final scorecard, and this really tells the whole story in one simple chart. Business quality? Check, absolutely. Financial strength? Big check, no doubt. Management? We're giving that a yellow light, a little bit of caution there. But the valuation, the price you have to pay today, that's a clear no. It's just too high to offer that all-important margin of safety.
You know, this quote from the original analysis we looked at just sums it up perfectly. It calls Adobe a wonderful company at a price that may be slightly fair but lacks a sufficient margin of safety. And that's it in a nutshell. It's a classic case of a fantastic business that isn't necessarily a fantastic stock to buy, at least not today.
So what's the takeaway here for an investor? What do you do with this information? Well, the recommendation boils down to a hold or, at best, a weak buy. If you already own shares, hey, it's a great business, so you probably just keep holding on. But the price right now just doesn't justify rushing out and making a big new purchase. The smart move, the patient move, is to put this wonderful company on your watch list and just wait. Wait for a better opportunity, for a bigger discount to come along.
And that really leaves us with the final critical question that you have to ask yourself. We've seen that Adobe is without a doubt an elite business, but the discipline of great investing is all about separating that quality from the price you pay for it. So I'll leave you with this. For a company this good, what price would you be willing to pay? How big of a discount, what margin of safety would make you feel comfortable enough to pull the trigger and buy?